On June 12, 2026, SpaceX went public. It raised $75 billion in a single day, the largest IPO in stock market history, by a wide margin. The previous record, Saudi Aramco in 2019, had $29 billion. SpaceX more than doubled it. By the closing bell, SpaceX was valued above $2 trillion, larger than Microsoft, larger than Alphabet, one of the 6 biggest public companies on Earth, on day one. But here's the part almost nobody covered. In the weeks after that IPO, millions of Americans who never touched a SpaceX share, never opened a brokerage account, never read a prospectus, may quietly end up owning it. Not because they decided to. Because of a system running underneath their retirement accounts, one most people have never heard of. Today, that's what we're going to explain. To understand this, you need one of the biggest shifts in American investing over the past 30 years, the rise of passive investing. For most of the 20th century, investors and retirement funds paid professional managers to pick stocks. Then, starting in the 1970s, a simple idea took hold. Most managers, over time, don't beat the market. They charge fees, they make mistakes, and on average, the market outperforms them. So why not just own the market? That's what an index fund does. Instead of picking stocks, it buys every company in a predefined list, an index, in proportion to each company's size. No research, no analysis, no judgment. Just track the list. The most important list in the world is the S&P 500, the 500 largest U.S. public companies. Roughly $7.5 trillion in passive assets track it directly, and another $3.4 trillion is benchmarked against it. That's more than $10 trillion moving based on what a committee decides belongs on a list, not on what any investor thinks. And here's where it touches you. If you have a 401k, there's a good chance some of it sits in an S&P 500 fund, a total market fund, a Nasdaq fund, or a target date fund holding all of the above. Maybe you chose it years ago. Maybe your employer defaulted you into it. Either way, when these funds change what's on their list, every dollar in them adjusts automatically. No vote, no notice, no decision required from you. So here's what's actually happening with SpaceX. There isn't one index. There are several, each with different rules, timelines, and amounts of money following them. 3 matter most. First, the Russell 1000, the 1,000 largest U.S. public companies. Under FTSE/Russell's rules, SpaceX entered it roughly 5 trading days after its IPO. If you hold a Russell 1000 or total market fund, you may already own SpaceX. Second, the Nasdaq 100, the 100 largest non-financial companies on the Nasdaq. In May 2026, Nasdaq added a fast entry rule. Any company ranked in the top 40 by market cap can enter after just 15 trading days. SpaceX is Nasdaq listed and valued near $2 trillion, so it qualifies, putting its entry around late June or early July 2026. That triggers automatic buying from every fund tracking it, including QQQ, the Invesco fund with roughly $500 billion in assets. If you hold QQQ, you're likely to own SpaceX by early July, whether you wanted to or not. Third, the S&P 500, the big one, $7.5 trillion, the foundation of most American 401ks. And here, something unusual happened. SpaceX does not currently qualify. Not because of size, it's worth nearly $2 trillion. The problem is profitability. To be included, a company must have posted positive GAAP earnings in its most recent quarter and across the prior 4 quarters combined. SpaceX posted a net loss of $4.94 billion in 2025 on revenue of $18.67 billion, up 33%. The loss is largely tied to its early 2026 acquisition of Elon Musk's AI company, XAI. The result? Too large to ignore, too unprofitable to join, at least for now. In the weeks before the IPO, things got genuinely interesting. S&P Dow Jones Indices did something it almost never does. It opened a public consultation from April 30th to May 28th, 2026, asking whether the rules should change. Should large IPOs skip the profitability requirement? Should the waiting period shorten? Should float rules relax? If the answer was yes, Bloomberg Intelligence estimated S&P 500 inclusion would have forced passive funds to buy roughly $14 billion in SpaceX shares. Not because any manager judged it a good investment, but because the rules would require it proportionally, automatically. $14 billion of demand generated by a rule change. On June 4th, 2026, 8 days before trading began, S&P decided. It rejected every proposed change. The committee's statement was blunt. Exceptions to the financial viability, seasoning, and float requirements should not be granted solely based on market capitalization. As strategist Art Hogan of B. Riley Wealth put it, it speaks highly of the credibility of S&P Dow Jones Indices to be rules-based and make sure there's profitability before entrance to the index. So S&P 500 inclusion is off the table until at least mid-2027, and only if SpaceX turns GAAP profitable, which Evercore ICE analysts don't expect before 2027 at the earliest. The structural result? The S&P 500 and Nasdaq both claim to represent the U.S. market, but one now contains a nearly $2 trillion company and the other doesn't. Two Americans with identical 401ks could have completely different SpaceX exposure, based entirely on which fund their employer defaulted them into. To see why this matters beyond SpaceX, look at the last time a company this size entered the S&P 500 from outside. Tesla, in 2020. When Tesla's inclusion was announced that November, passive funds had to buy an estimated $58 billion worth. Between the announcement and the inclusion date, Tesla's stock rose roughly 70%. Why? Sophisticated investors understood the mechanism. They knew index funds would, by rule, have to buy enormous volume on a specific date. So they bought first, drove the price up, and the index funds, your retirement funds, had no choice but to buy at the top of a mechanical spike. Morningstar later found that in the year after inclusion, Vanguard's S&P 500 fund, VOO, lagged its total market fund, VTI, by 67 basis points, partly because VOO was forced to buy Tesla at a premium. This is the index inclusion effect. The system is transparent. Rules are published, inclusion dates announced in advance, which means the passive investor sometimes ends up as the last buyer. Not because anyone's cheating, but because predictable rules let sophisticated capital position ahead of them. Apply that to SpaceX. The Nasdaq 100 inclusion creates one wave of forced buying around early July 2026. An eventual S&P 500 inclusion, if it ever comes, could create a second and larger one, $50 billion or more by some estimates. That's not a prediction, it's a structural observation, and it reaches anyone holding a QQQ tracking fund in their 401k, whether they know it or not. Here's where we leave this. SpaceX is now public, the largest IPO in history, entering the Nasdaq 100 and Russell 1000 automatically, by rule. It may eventually enter the S&P 500 if it turns profitable and the committee decides to add it. And if it does, tens of billions of dollars will move automatically into a company millions of savers never consciously chose to own. But the deeper story isn't about SpaceX. It's about what SpaceX reveals. We've built a system where roughly $10 trillion in retirement savings moves, not on the judgment of the people saving, but on the decisions of a small committee running a century-old index methodology. Their rules determine which companies get the mechanical support of trillions in passive buying, which get left out, and who ends up holding what and at what price. Most Americans making their 401k elections have no idea any of this exists. They pick the default or the low fee or what a coworker mentioned. And somewhere downstream, a committee makes a ruling about a rule those savers have never read, and their retirement account adjusts automatically. The question worth sitting with isn't, should I buy SpaceX? It's, do you understand the system your money is already inside? Because the mechanism doesn't wait for you to understand it. Those answers aren't in the headline. They're beyond the Chyron.